Good afternoon, everyone. I'd like to welcome you all to the Halftime Talk feature interview series, where we every month sit down with Christof Rühl from Columbia University and also on the board of Crystal Energy to get his insights on the month that we've just had, but also, more importantly, the month ahead. Everyone's got a lot of questions, Christof, trying to read this energy market, and obviously Donald Trump, one of the people making it very difficult for us to do so. But I mean, let's start with talking about, just get to the bottom of prices. I mean, a month ago, when we last talked to you on this particular program, the front month Brent was around 100, $115 or so. Today, we find ourselves, 20 more plus dollars down from that. Now, would you explain that purely that, the war, no more hot war is going on, and there's expectations that the Straits of Hormuz will open? Why are we seeing this price drop, and why is it holding there for the time being?
I think there are really, as you hinted, there are two things that work here. One is we have now had a long period, in terms of months at least, a few months since the start of the war, where the headline price just responded to the headline on the terminal or in the news, and fluctuated pretty wildly driven by political events. But underlying all of this is the observation, which has been made very often by now, that the price increases were actually less than expected by most. And underneath what we have seen, just specifically the last few weeks, these negotiations about a deal which come and go and come and go, is that the volatility slows down a little bit, but the underlying current of a less than expected price increase is undoubtedly there and is getting stronger. So we are still below 100 when they're shooting at each other. That wouldn't have been possible 2 months ago. And I think what this points at is the bigger mystery, which is what is going on here in terms of the demand and supply balance, when everybody says the biggest oil shock in history. And people really, in various quarters, what they do is count down. They see that as a race against time. They see that as inventory buffers, which are depleted at a rapid clip. And so it becomes just a matter of arithmetic to calculate until the house comes down. And that view is probably false. And that's what the market tells us.
Well, I mean, given that inventories now we're approaching the end of the second quarter, we started the war 3 months ago with very generous buffers of oil everywhere, oil on the water, Russian and Iranian oil. As far as we know, very good inventories in China and the US and the OECD countries. Those have been drawn down clearly in the last 2, 3 months. So, and everyone's talking about that the Q3 will be the crunch point. So how impacted do you think the physical market is going to be in terms of inventory supply, feeding those economies in the third quarter, if we assume that the Strait of Hormuz situation is not resolved and we don't see any extra oil coming back on to the market? I mean, is Q3 going to be the alarm bell kind of quarter? We haven't really had one in a greater sense. As you said, the oil prices should be much higher than where they are, given all the factors.
What does that mean? Oil prices should be much higher. So
Yeah.
I think this
Demand is not
it's
strong.
well, yeah, it's what you expect. If I don't know, the people do expect that they should be higher, but they aren't. So maybe we should reverse the question, ask why aren't they higher?
Yeah.
And I think, of course, it's obviously a very complex picture, but there's a few developments right at the center of it. One is that in these situations, time is not only the enemy, it's not only a clock ticking down. Time is an asset, because the longer time we have, the more adjustments in the market can proceed, and these are adjustments on the supply side. The second one is that these shocks are not sort of one-off hits at the global oil market. They are regionally dispersed. So first, of course, it hits Asia. If you have a decline of 10% roughly of global oil production and it hits one region, then this is much more pronounced than if it hits the globe. And now it's spreading from Asia, but this is already part of the rebalancing. Exports from the Atlantic Basin to Asia, the shortage is spreading around, the price increase is spreading around. Two, it hit different fuels at different speeds.
Yeah.
Inventories were largely crude inventories, and as we know now, the story of refining adjustment is an amazing story, and I would say it's the usual amazing story. So I think that one big message is that time is not just the enemy. It can be an asset in helping on these adjustments, and the shock has been a shock which is not hitting a homogeneous system. It has hit it at a particular place with regionally and with particular big impact on certain fuels, and so there is scope for the adjustment of the global system to mitigate a little bit this impact. Having said all that, it's still a huge shock. And so the question is, what kind of adjustments do we see on the supply and on the demand side?
I mean, you mentioned the refined products versus crude. I mean, we've seen that, it's been very much a refined leading crude kind of market since the crisis began, and even before that, to be fair, in terms of when we had a more bearish outlook. Do you see that continuing to be the case, that the real crunch point, despite the fact that we have tankers of crude stuck in the Strait of Hormuz and not being able to transit there, when we look at the second half of the year, are we still looking at concerns more centering around the refined product mix and those flows making it to where they need to go?
Well, the implication of this shock hitting particular parts of the system and then spreading through the system is that it becomes easier to digest and that it becomes less acute at these areas like jet kerosene and in Asia, where it had the first impact, and becomes more severe in areas like the Atlantic basin, where it hasn't really hit yet. A very good example is that story, which by now everybody knows. Why did US gasoline prices increase more than European gasoline prices at first? Because the price differential, the crack spreads for jet fuel production were so much higher that US refineries switched away from producing gasoline and produced jet fuel, which was exported. Now that, if you sit in the US, looks like a very first indicator of exactly what we discussed earlier, this countdown and problems for the economy. If you look at it from a global perspective, it's a perfect example of an adjustment which we would expect. And on the refining side, time and again and again and again, we have made this experience of these hurricanes or attacks or other disruptions, that this refining system is enormously flexible and much better at digesting shocks than we think. Stepping back, you have to ask, what can be done on the supply side to find workarounds to mitigate this, whatever, 14 million barrels per day disruption of crude and products, and what will be done on the inventory and then on the demand side as a balancing item. And we already know that there are, of course, some effects which took place already on the supply side, the pipelines in the UAE and Saudi Arabia, and to some extent in Iran itself, the trucking from Syria, the increase in production in the US. But we also know these are small things in the big scheme of things, and they will take more time. They will work themselves out over years rather than months to become significant. What we also have seen is that inventories, as you mentioned, were indeed much higher than most people had expected, and so they produced a much bigger buffer. Most of it was invisible. So floating storage, for example, was a big unknown. How much is really in China strategic storage? How much did go in there over the last year when the Chinese bought it on the cheap and prevented oil prices from falling further? And that is an estimate. So if you have the 14 million barrels per day disruption, and about less than 2 million adjustments on the supply side already incorporated, then the visible inventory drawdown so far is for March and April on average a little more than 4 million barrels per day. So that leaves, say, roughly 9 million barrels, which could be an inventory draw or a demand of invisible inventories, non-recorded inventories, or demand adjustment. We just don't know. My guess is that the part which is demand adjustment is already much higher than most the IEA and others estimated, in particular also in China. So we have not only bigger inventories to start with, but also a bigger demand reaction already in the system.
Okay, that's interesting. I mean, I want to get on to China, but let's just make assumptions. Let's be economists. Well, you are an economist, and just make an assumption. Now, most of the commentary today is that we're not going to see a deal, obviously, tomorrow. It's going to take months. This back and forth, these headline-driven yo-yo coming out of the United States, and of course, Iran and others reacting to that. If, let's say, we were at the end of June to have a concrete, proper peace deal that's going to be, well, let's say we're open. Iran says we're opening the Strait of Hormuz. We're not going to ban. Let's say there's a deal that is done. How long then would it take these 10 million barrels that have been not exported from the Gulf, etc.? How long would the physical market take to really get back to normal, in your opinion, if we actually had a concrete opening end of June and no more skirmishes? Just tell us about the trajectory of that
It
back to
would
a
have,
normal market.
by normal market, I guess you mean back to prices of 60.
Well, prices will result from that, but in terms of flows, in terms of actual physical flows.
So the disruption will come back it will surprise, let's put it this way, it will definitely surprise everyone how fast it will happen. We will be
Okay.
back in no time in a market where supply is larger, where production is larger than demand, and we will see price adjustments. And the background of this is the second big thing, which many people still underestimate. It's not only that time is not the enemy here, it's also that markets really have changed in the sense that the oil intensity of the globe has decreased by so much that prices have a really long runway in order to become meaningfully high. And what I would say is that current prices are not high by historical standards if you
Yeah.
adjust them not only for inflation but for oil intensity. They're actually sort of very middle of the road, lower end. So the runway here would be not 120 or 130, it would be way above 300 to really cause damage. What we have, I think, is a highly nonlinear situation. There's a huge runway for prices to go where the effect will be relatively modest on economic growth, and as we see now in the
Interesting.
data, is relatively modest even on the inflation side. And only if prices are really meaningfully higher and would impact load-bearing barrels, which would have a cascading effect on the economy by disrupting supply chains, as opposed to just taking away purchasing power from consumers, only then would we really see a crisis situation. And with every day that passes, I think that crisis cliff edge, which people are talking about and counting down to 15th of July or 1st of August,
Yeah.
moves further away, in fact. And that's the picture as I see it. And if the strait in your question then opens in the midst of that process of adjustment, which is already underway, then of course it accelerates you back to normal, accelerates, and you will see markets jump, stock markets being very joyful.
Well, they're already very
Everyone's
joyful. I
looking for
don't
the
think,
next problem,
I'm
and
not
oil
sure if
markets
we can,
normalizing fast.
yeah, and normalizing and by normalizing, do you mean go back to about $60 a barrel, which is where we were hovering for many months before the war
People
started?
will replenish their inventory, so demand will be higher, but it's not going to be making a big difference in the grand scheme of things, not in the inflation side for central banks, and much more important, not on the economic growth side. Economic growth prospects will be all market plus 15 other things again.
Okay, I mean, and so that means Donald Trump has a lot more leeway to play with then before he starts to panic. If oil prices do go back up to 120, why wouldn't he let them go up higher? If you're saying economically, on an inflationary basis, and otherwise, the U.S. economy, which is what he cares about, will be okay. So could you see him letting prices go? Because last time they got to 150, 120, that's when we saw the geopolitical panic sort of kick in on his side. Oh no, I've got to control gasoline. I've got to, try and prevent inflationary negative outcomes. But do you think now that there's more predictability in what we've seen, you think he'd let that ride higher as a
You
negotiating
could
tactic?
you could argue that he already is doing this, that he already has advice who tells them, look, don't panic, your situation isn't as bad. We can trot along a little longer. I doubt it. The only reason I doubt it is not that it's analytically not correct. It would be possible to make that case quite convincingly. The reason I doubt it is that one shouldn't overestimate the intelligence of this decision making in this administration. We saw how it all started. I mean, it's still mind-boggling to me how any US and Israel, or any administration for that matter, could attack a place like Iran without having a plan B for closure of the Strait of Hormuz. That's sort of the ABC of
Yeah.
any oil analyst for 100 of years and 40 years maybe, but still. And I do think that I didn't believe that for 2 weeks that there was no plan B. I really thought they couldn't be, excuse my terminology, so
Yeah.
stupid. But having
Yeah.
committed that big mistake, I wouldn't rule out other big mistakes down the road, and I wouldn't overestimate the analytical capacity of that administration. That fact remains, however, that we have much less reasons to panic if by panic is meant a sudden crisis erupting from inventories going down to zero and the house coming down. That is very unlikely to happen at this stage. Big if, there is no further physical destruction of infrastructure.
Okay. Christof, we haven't had you on the program since we had a new Fed chair brought in America. You've got the new Kevin Warsh, and of course, many people saying he was brought in because he's going to be a yes man to Donald Trump, who wants to bring interest rates down. Where do you see the trajectory for the rate story in the next month or next 3 months, let's say? Some people saying that we don't, we cannot drop interest rates more because there's that inflationary risk now. It's greater than it was 3 months ago. Do you see a trajectory for interest rates, a more likely one than not?
I think there's a strange coincidence of two factors. I don't think that he's just a yes man. Kevin Walsh has a very high-held belief that productivity in the US will accelerate massively as a result of artificial intelligence, and that will allow him, give him the scope for avoiding further interest rate increases, even if there is inflationary pressure. So that allows him for a lower interest rate policy. And the American president, as we all know, wants lower interest rates, full stop. And so that coincided. The question was, could this happy marriage, how long will it last? It will not last forever, that's for sure. And can its end be accelerated, or can it be extended by the current oil market situation? And the answer most likely is that the current oil market crisis, the longer high prices, have more pressure to actually raise interest rates than would have been without it. But if our discussion or our analysis, which we just had the last 10 minutes, is halfway true, then that pressure is much less effective than one would suspect from the outset and by reading just the financial press. So lo and behold, I would argue that there is a few months until the spring or so, until when he can reasonably argue we have to wait and see. And where President Trump, presumably from a political viewpoint, doesn't want to rock the boat immediately and can conveniently argue, okay, let's see what happens down the road. And then there will be a flashpoint of discussion around the midterms. But if both survive that without major clash, then the cards are on the table and mix anew, and they can assess it in late autumn, how the inflationary situation actually develop. It will not only depend on oil prices, of course.
Of course, we still see the equity markets roaring ahead. I mean, the Nasdaq's up 20% since the last month, since the ceasefire scenario was announced. I mean, plenty of liquidity there still sloshing around in the equity markets, right? There's no lack of that. I know it's being AI driven and tech driven, but no hesitation there. I mean, do you think this is the final 6-month run until the midterms, and then we see a turnaround, or should we stop saying that?
It is, as you said, very heavily concentrated in AI and AI-related infrastructure. And I do think there will be an inflection point where the negative effects of AI on employment, on certain segments, the inflationary push which comes from all the demand for energy and semiconductors and all, will also show up in segments of the stock market suffering. But even if I believe that global growth will moderate and come down a little, and that should have an effect which takes the air out of stock markets, it looks as if AI is really more transformational and more sustainable at current prices even than the earlier dot-com bubble. And it looks as if at least that segment continues to grow because, of course, everybody then says, okay, let's forget the rest and pile money in there. And that will eventually create a bubble. But I don't think we are in bubble territory necessarily now.
Okay. And Christof, before we let you go, I mean, let's talk a bit about trade and tariffs, because, the war has distracted from that, obviously. I also sort of want to ask you about Russia as well and the oil market there. But let's talk a bit about trade, tariffs. A year ago, we were still reeling from, the April deadline and the April announcements by Trump on tariffs on China and the rest of the world. Not so many headlines today. Obviously, those negotiations are still ongoing. How nervous are economies like China or Europe about the whole tariff story?
I think the economic expectations have calmed down a little bit. The worst of the tariff things have been either stomached better than expected in terms of inflationary impact, supply chain disruptions, and all these dire predictions. And the very worst spikes in tariffs have been eliminated by China sort of standing up and not letting
Yeah.
itself being bullied around. But even the Europeans sort of moderately meeting to try to get their act together. And if Trump may, heat up the rhetoric a little bit as he did yesterday again, but that would be perceived widely as a run-up to elections, to the midterms. I think that hopefully has been stomached and blown over a little bit. The real effects of the existing tariff increases will only show up in the longer term. In more costly reroutings of supply chains and more costly reallocations of factories. But the underlying trend, which we have seen since COVID and Trump and now with the oil market crisis accelerating, of the fragmentation of the global economy, of the process of globalization not disappearing but slowing down decisively, and with this idea that we don't live in one world but in different hegemonies, sort of a part of
Yeah.
Asia is China, Western Hemisphere is the US, and God forbid Europe, and east of it is Russia. That political ideology seems to be here to stay. And I always think, sometimes I think that maybe the Trump winds have blown over and he's out of office in a few years and the Americans return to normal. And then at that point, Europe turns to all these populists and becomes really bad. So that is still a plausible outcome. What I'm trying to say is the uncertainty on the political side that this fragmentation and hegemonial thinking and anti-globalization thinking, which is economically dangerous,
Yeah.
Indications are it will not disappear anytime soon.
Yeah, the fracturing on that economic sort of globalization front. Christoph, just on the Russia point, because again, it has been yes, it's still an intensive war with Ukraine, has had some serious losses and hits in the last 3 months, and that conflict doesn't seem to be going away anytime soon. But from an energy, oil export sales point of view, Russia's been doing very well. Higher prices, eyes off the sanctions completely in terms of the oil, reaching its destination. Would you say that's a new paradigm now? Although we strictly have sanctions still in place, but the world doesn't care about that anymore.
The answer is a mixed picture because in terms of the global oil markets, Russian overall exports have increased slightly since the attack of Iran, but that's entirely on the crude side. Refining
Yes.
has dropped massively, and that's a result, for the most part, of the successful Ukrainian attacks on Russian refineries.
Yes.
And as we know, the shortage of the Iranian shock is in products, and diesel is part of that, and mazout or diesel is a big part of the refined exports from Russia. But within Russia, this is likely to continue because for Ukraine, it's an incredibly promising strategy. Within Russia, the budget in February was about to be sequestered by 10%. The budget cuts because the war is getting too expensive, which would have fallen entirely, of course, on the civilian sector. They got a little bit bailed out by the higher prices for oil after the Iranian invasion. But if that doesn't persist, then the financial pressures Russia is under are much larger than a year or two.
Yeah.
Not deadly yet, but large. And so the Ukraine, with America walking away, has all the incentive to continue attacking Russian export infrastructure and refining infrastructure. And that means Russia is becoming really a wild card on a bigger level than before, when they were just shipping out using a ghost fleet rather than using the official channels. And that complicates the Iranian picture too, in addition.
More and more complications every day. Christof Rühl, Senior Research Fellow at the Center for Global Energy Policy, Columbia University. Thanks so much for joining us today on Halftime Talk. It's been great to get your updated views.
Thank you. Yeah, it's basically more positive, despite being complicated.
Well, let's hope so. Thanks so much, Christof.